Now, I'm guessing that most of you are probably familiar with the basic concept of a corporation. Basically, if you think about any large company, that's going to be a corporation. Your common examples, General Motors, Walmart, Microsoft, Amazon, Apple, you name it. Any of the big companies are going to be corporations. And there's a variety of reasons for that, why that type of business makes sense for a big company. Some of the unique characteristics of a corporation are it is a separate legal entity from the owners. There is no limit on the number of people that can own stock in a corporation. For example, big companies, they're going to have their stock traded on open exchanges, such as the New York Stock Exchange, NASDAQ. Essentially, anybody can go out there and buy and sell their stock. So there's no limit on how many people can participate in the ownership of the business. There's no personal liability for the owner. So for example, if you go out there and, you buy 10 shares of Walmart stock, you're not going to be personally liable for any of the obligations of the company. Lack of mutual agency. This just essentially means that the decisions that are made by management are not going to affect the individual shareholders outside of any effect that it could potentially have on the share price of the organization. There's no life on a corporation. It will exist indefinitely unless it goes out of business. Last week we learned about partnerships where if one partner leaves, or if you want to admit a new partner, you have to essentially dissolve the old partnership and create a new one and that sort of thing. That's not the case with a corporation. Ownership can change hands continuously and it doesn't affect the status of the corporation. Taxation. Corporation is taxed as a separate entity, meaning it is not a flow-through entity. Last week we talked about a lot of flow-through entities. Those are our sole proprietorships, LLCs, our partnerships, S corporations, and those types of companies, the profits and losses flow through to the owners of the company and they pay taxes on an individual basis. Corporation, that's not the case. A corporation pays taxes on its income based on corporate tax rates. Now, that's where we get the term double taxation, and that is often cited as one of the disadvantages of the corporate form. Now, when we say double taxation, we do not mean that the corporation itself is paying tax twice, but what happens is the company pays corporate level income taxes on their earnings. If they decide to distribute those earnings in the form of dividends, the shareholders will then have to recognize the dividend income and pay any associated taxes on the dividend income. So that's where we get the term double taxation. And then, of course, a corporation is allowed to accumulate capital, and we're going to learn more about that as we go, but that's essentially retained earnings when they choose to accumulate and retain the earnings of the business. Now, I included this because I think it's a good little chart. You can find it there in your textbook. I think it's something neat to refer back to. It just kind of highlights the basic advantages and disadvantages of the corporate structure. Now, again, there are disadvantages. We talked about double taxation. The startup costs are going to be higher. There's going to be a lot more regulation and oversight involved. However, the advantages are substantial enough that if it's a big company, it's really the only logical choice in terms of business form. Now, we know that corporations issue stock, and that's essentially the difference that we're going to see in terms of the balance sheet. The balance sheet for a corporation is going to look essentially the same as the balance sheet for a partnership, with the exception of the stockholders' equity section. Other than that, the balance sheet's identical. We treat assets the same way, we treat liabilities the same way. Where we really see the difference is the equity section of the balance sheet. Because a corporation has stockholders, we are going to have corporate stock. Okay, and I like this diagram here because it's very common for students to kind of get confused when we start talking about the number of shares, because you have authorized shares, issued shares, and outstanding shares. Okay, so let's talk about what each of these mean. Okay, the biggest number is going to be the authorized shares. And that is basically going to be somewhere within the articles of incorporation. It is going to be the total number of shares that the company is authorized to issue. Very few companies are going to issue, the maximum number of shares, okay? So normally they're going to be authorized to issue some very large number of shares, and they're going to choose to issue a portion of that, okay? So that becomes the issued shares. As soon as the company decides to issue those shares and those shares are sold out to investors, those shares become issued. As long as they are in the hands of investors, they are considered to be outstanding shares. Now, you may say, well, once they're issued, why in the world would they not be in the hands of investors? And we're going to learn a little bit more about that as we go here in our lecture. But essentially, a company has the option to buy back their own shares. They can either hold them in Treasury or they can actually retire those shares. So if they do that, if the company buys back their own stock or retires those shares will always be issued, but they're no longer outstanding, okay? So as a quick recap, authorized, that's the total maximum number of shares the company can possibly issue, okay? Issued, those are the number of shares that have at any point been sold to investors. Outstanding shares, that's the number that is currently in the hands of outside investors. Now let's talk about stockholders' rights. The stockholder has 4 basic rights. First, they're able to vote. Second, they have the right to receive dividends, assuming that the company decides to pay dividends. With that being said, the company is not obligated to issue dividends, but if they do issue dividends, then the shareholders have a right to receive them. In the event of a liquidation, stockholders have a right to receive any residual assets remaining in the company. With that being said, creditors have preference over stockholders in the event of a liquidation. So if a company liquidates, that means all of the creditors are going to be paid first. If there is anything left over, that will go to the shareholders. In most cases in a liquidation, there's not going to be anything left or very little left. Normally, that's why the company is probably liquidating. And then Number 4, we have a preemptive right, and that just means the stockholders have a right to maintain their proportional ownership. So if the company decides to issue additional shares, those existing stockholders must have the opportunity to purchase such shares if they wish in order to retain their proportional ownership level. Okay. Capital stock, we're going to talk about 2 primary types. We've got common stock and preferred stock. Pretty much common stock is, as the name implies, the most common, and that's the one that pretty much every large company is going to have common stock. Sometimes you see preferred stock, but it's not nearly as common. Preferred stock is generally considered, from the perspective of the investor, it's considered to be a more secure stock. It doesn't have quite as much risk associated with it. It normally has dividend preference, but it's also a lot more expensive. And the holders of preferred stock generally expect to receive some kind of dividends. And so that's one of the reasons that you don't see just a whole lot of companies issuing preferred stock. Again, we're going to learn about both. But common is definitely the one that you are going to see most frequently. When it comes to par value, we're going to learn how to account for stock with par value. But in the real world, a lot of companies issue no par stock. If they do issue stock with a par value, it's normally a very, very low amount, kind of an inconsequential amount, you might say. Okay. Shareholders' equity or stockholders' equity, okay, it can be broken down into two basic components. You've got contributed capital or paid-in capital, and you've got retained earnings. The contributed capital or paid-in capital is essentially the amount that we have received from shareholders in exchange for the purchase of our stock. Retained earnings is just the accumulation of net income and or net losses reduced by any dividends that have been paid. All right, so now we're going to look at some examples, okay? First, we are going to start here with issuing stock at par value. So they tell us that Smart Touch Learning's common stock has a par value of $1. They're authorized to issue 20 million shares of stock, but they decide to issue 15,000 shares. And this kind of goes back to our chart that we were looking at. Remember, I said the authorized amount is usually going to be a very large amount, and then the company has to decide how much they want to issue. So they're authorized to issue 20 million shares, but they decide to issue 15,000 shares, and they are going to issue it at par value in this case. So we simply debit cash for the $15,000 that we receive from the investors, and we credit common stock for $15,000. All right, and now this time they are going to issue an additional 3,000 shares of stock, but this time they are not going to sell them for the $1 a piece, the par value. They're going to sell them for $5 a piece. All right, so that $4 difference is essentially a premium on the stock, and that is going to go to paid-in capital in excess of par. Sometimes you will also see this presented as additional paid-in capital or APIC. That's APIC. It can, the account can be titled either way, but I mention APIC simply because if you're looking at real world financial statements, if you go to the SEC website and you're downloading a company's financial statements, it's pretty common to see it listed as APIC or additional paid-in capital, or sometimes it'll just say paid-in capital. But that way you kind of know what you're looking for. It sometimes goes by different names. Now, let's see how this is going to look on the financial statements. So here we have a partial balance sheet. So here we're just looking at the stockholders' equity section of the balance sheet. All right. So what we see first is we see the common stock listed at par value. Okay. So the par value for the shares issued is the 18,000. That's the 15,000 shares plus the 3,000 shares issued times the $1 par value. Okay, and then remember on that second issuance, we got some additional paid-in capital because the stockholders paid more for the stock than the par value. So that's where we get the additional 12,000. So our total paid-in capital or total contributed capital is 3,000. And in this case, we're assuming that we have retained earnings of $3,550. So total stockholders' equity comes to $33,550. All right, so now let's talk about treasury stock. And I mentioned this a little bit earlier, but treasury stock is essentially stock that has been issued and the company decides to buy it back. There are a variety of reasons why a company might decide to buy back their own stock. It can be to avoid, some sort of takeover that they don't want. It can be to fund employee stock option plans or other stock ownership plans. But probably the most common reason that companies buy treasury stock is simply because they feel that the stock is undervalued on the open market. Basically, they feel like the stock is selling at too low of a price. So what happens is if they buy back a portion of that stock, let's think about how supply and demand works. You may have to think back to your economics courses on this. If the stock is selling at a fairly low price, but the company buys it back and reduces the supply, that is out there on the market, most likely the share price will go up on the remaining shares. So it's kind of a technique that can be used to drive up share price a little bit. Again, from the company's perspective, it makes sense to do it if they feel like the stock is selling at a good price. They're essentially investing in their own shares. Okay, so some key things that you need to know about Treasury stock. All right, it is what we call a contra equity account. Now, you probably remember from your prior financial accounting studies what contra accounts do. They carry the opposite balance of their partner accounts. All right, so Treasury stock is an element of equity. Normally, equity carries a credit balance, not Treasury stock. Treasury stock carries a normal debit balance, which means that Treasury stock will essentially reduce our total stockholders' equity that we report on the balance sheet. Okay, so let's look at an example. Here, Smart Touch decides to buy back 1,000 shares of their previously issued common stock. This time they are paying $5,000 a share. Okay, they are going to record this at cost based on what they paid for it. So in this case, Treasury stock goes in for $5,000. We credit cash for $5,000 to record that purchase. Okay, now they may at some point decide to reissue that Treasury stock. All right, in this scenario, we're assuming that they reissue the stock at cost. So they end up reselling the stock for the same $5 price at which they purchased it. Now, in this case, they're only going to sell another 100 shares. Okay, so we simply debit cash, credit Treasury stock based on the $5 per share price and 100 shares. Now, there may also be scenarios where they sell the Treasury shares at more than the cost that they paid to get them back in Treasury. So in this scenario, we're going to assume that they sell 200 shares, but this time, instead of paying the $5 or selling them for $5 a share, which is what they purchased them for, they're going to sell them for $6 per share. So in this case, we're going to debit cash for the entire amount. We're going to credit Treasury stock based on that $5 cost, basically how it went into Treasury. And then the difference is going to go to the paid-in capital Treasury stock account. Now, here's where it gets really interesting. Let's look at what happens when they sell those Treasury shares for less than cost. Okay, so this time, the company bought those shares back at $5 per share, but we're going to assume that they decide to reissue 200 of them, but this time for $4.30 each. Okay, cash. I'm gonna tell you, the great thing about the cash account is cash always just simply is what it is. Okay, when you're looking at a journal entry and you're trying to figure out where everything goes, I can tell you that in most cases, cash is going to be the easiest piece to figure out. Okay, you just ask yourself, what happened to cash? How much did we pay or how much did we receive? Okay, well, if we sold 200 shares for $4.30 each, then we received $860. That's simply the 430 times 200. So for that reason, a lot of times I'll tell students, if you're having trouble figuring out how to account for a transaction, start with cash because it's normally a pretty simple piece to figure out. Okay. All right. And then the next piece, remember, we are going to take these out of Treasury stock based on cost. And we had them in at $5. So guess what? They're coming out at $5. Now, in this case, we do the cash and we do the Treasury stock piece, we're missing a piece. Our journal entry is not in balance. So we just have to ask ourselves, what's needed to balance? And in this case, it's going to be a debit to the paid-in capital Treasury stock account for $140. And that simply represents that 70-cent difference between the $5 cost and the $4.30 selling price. Because remember, normally paid-in capital would have a credit balance. So when we debit paid-in capital, we are essentially reducing the paid-in capital account. Okay, now it says what happens if Smart Touch Learning resells an additional 200 Treasury shares for $4.50 each on April the 4th. And here we see what that entry looks like. And again, guess what? The easy piece, always cash. Always cash. $4.50 times 200 shares. That's an easy piece. All right. And then the Treasury stock is always going to come out based on cost. And then in this case, we're going to have a debit to paid-in capital from Treasury stock 60, and we are going to debit retained earnings for 40, which represents the 1,000 less the 900 less the 60. Now again, remember, retained earnings has a normal credit balance. So when we post a debit to retained earnings, we are reducing retained earnings. All right, so here is a nice little diagram that kind of shows how the authorized, issued, and outstanding shares work. All right, so again, we have a big amount of shares that are authorized. A company chooses to issue a portion of those authorized shares. So basically, for our total shares that are authorized, we have a portion that's issued, a portion that's unissued. Within issued, we have a couple of possibilities. We have a portion that will be outstanding, and then we have a portion that's not. In this case, the portion that's not is the Treasury shares at 300. But again, we could have retired shares as well. But that kind of shows the relationship there between the authorized shares, the issued shares, and the outstanding shares. Now, let's talk about dividends. When it comes to cash dividends, we have 3 dates that are going to be important. We have the declaration date, the date of record, and the payment date. All right, the declaration date is basically the date that the board of directors announces the dividend. As soon as they announce it, the company has a liability to pay that dividend. The date of record is really only going to be important for the shareholders. The date of record is what is going to dictate who receives the dividend. Now, you might think, well, shouldn't it be easy to figure out who receives the dividend? Well, it would, except we have to think about the way that the stock market works. People are buying and selling stocks all the time. So companies need a way to know, well, who is, the stock might have changed hands 5 times in the last month or 25 times in the last month. And we need to determine who is going to be entitled to receive that dividend. That's where the date of record comes into play. The person holding the stock on that particular day is the person that's going to be entitled to receive the dividends. And then, of course, the payment date, that is the date at which we actually pay out the dividend. Okay, so here's an example. On May 1st, Smart Touch Learning declares a 5-cent per share cash dividend based on their outstanding shares of stock. And we see that on the date that the board of directors makes the declaration, we go ahead and debit the dividend account and credit dividends payable. Okay. On May 15th, that is the date of record. Now again, from the perspective of the company, no journal entry is required. However, that date of record is significant to the shareholders because that dictates who is going to receive the dividend. It is the person who owned that stock on May 15th. And then on May 30th is when they actually pay the stock. Pay the dividend. So we are going to debit dividends payable and credit cash. That alleviates the payable, the liability, and it records the cash moving out the door. Okay. And remember from your studies in financial accounting, at the end of an accounting period, we record what's called closing entries, and that moves our revenues and our expenses and any withdrawals or dividends into the retained earnings account. That's what happens to cash dividends. So Remember, at the time the board of directors declared the dividends, we debited the dividends account. However, that dividends account does get closed into retained earnings at the end of the accounting period when we close out with the accounting cycle. Now, sometimes companies may decide to issue a stock dividend in lieu of a cash dividend. I can tell you that stock dividends are most commonly issued because the company wants to provide some sort of return to stockholders, but they may not have enough cash on hand to really be able to justify sending cash out the door. So they may decide to issue a stock dividend instead. Now, a small stock dividend is generally going to be regarded as less than 20% or 25% maybe of issued and outstanding stock. A large stock dividend is going to be anything greater than that amount. All right, stock splits are a bit different from a stock dividend. With a stock dividend, after the stock dividend, there will be more shares outstanding, okay? So they do have somewhat of a dilutive per share effect. Now, what happens with a stock split is essentially the number of shares outstanding will increase proportionally, but the market price per share will decrease proportionally, okay? From the perspective of an individual shareholder, it will not affect the value that they're holding. Each share becomes worth less, however, they are now holding more shares. Now, you may think, what in the world is the point of this? Why would any company want to bother doing such a thing? There's really one reason. Sometimes stock price gets so high that it becomes somewhat prohibitive for a lot of investors. So when the stock price gets so high that it may actually kind of be a turnoff to some investors and they may not be interested in it because of the price, the company may decide to do a stock split, because what it effectively does is just reduces that price per share. So it kind of opens the door for more investors to potentially be able to purchase the stock. Okay, so here's an example here. Assume that Greg's Games has 3,150,000 shares issued and outstanding, $1 par common stock. The market value is $50, and they do a 2-for-1 stock split. Okay, what essentially happens is the par value goes from being $1 to being 50 cents, and the number of shares outstanding goes from being 3,150,000 to 6,300,000. Again, we have twice as many shares worth half the amount, but total equity remains unchanged. Okay, and I just included this. This is something you can make a note of and refer back to. This is Exhibit 13-9 in your chapter reading, but this is a great summary on the overall effects of cash dividends, small stock dividends, large stock dividends, and stock splits. So I would encourage you to make a note of this and refer back to it as you're working through the learning activities and the exercises for this week. Okay. Now, let's take a look at the sections on an income statement, okay? The primary section of an income statement that most investors are going to be concerned with are going to be continuing operations, okay? And so that's going to be the biggest chunk of the income statement, is continuing operations. So that's going to be our net sales, sometimes called revenues, less any cost of goods sold. In this case, we're essentially looking at a multi-step income statement. In your financial accounting course, you learn the difference between a single step and a multiple step. A single step income statement lists all the revenues together and all the expenses together. A multiple step statement, which is generally considered to be more useful by investors, breaks it up into kind of categories and subtotals. Okay, so with a multiple step statement, we start with our sales or revenues, we subtract our cost of sales or cost of goods sold, and that leaves us with gross profit. We can then deduct operating expenses, adjust for any non-operating items, and that will give us our income from continuing operations. Now, what falls outside of income from continuing operations would be any gain or loss from discontinued operations. So that's something that the company has decided that they will no longer engage in. Normally, a discontinued operation is going to involve the disposal of a significant part of the business. So it could be an entire operating segment. It could be like closing down a division, or maybe discontinuing an entire product line. Something like that could constitute a discontinued operations. The FASB has very specific requirements for what must be met in order for something to fall into the category of discontinued operations. But that is discontinued operations are presented net of tax. Then we get our net income, and at that point we are able to compute our earnings per share. And earnings per share should also be broken out between continuing operations and any items from discontinued operations, if applicable. Now let's take a closer look at some of the measures of profitability that we can obtain from the income statement and the balance sheet. We saw earnings per share presented on the income statement, and that's actually something to note. For publicly traded companies that have to file with the SEC, they must present earnings per share on the face of their income statement. Additionally, they have to present both basic earnings per share and diluted earnings per share. In the previous example, we're assuming that this company only had basic earnings per share, but diluted earnings per share looks at whether the company has any potentially convertible stock. Not all companies will, but if the company does have some potentially convertible securities, then they have to take that into account, and they have to also present diluted earnings per share. But right now, we're going to concentrate on basic earnings per share. Okay. The way that we compute basic earnings per share is going to be, we're going to take net income minus any preferred dividends, if applicable. Okay, if the company doesn't have any preferred stock, there's not going to be any preferred dividends. Common dividends do not count. Okay, not in this calculation. In this calculation, we're only concerned about the preferred dividends. So net income minus preferred dividends, if there are any, divided by the weighted average number of common shares outstanding. Okay, some of the more common profitability ratios that investors are going to look for is going to be the earnings per share, the price to earnings ratio, also called the PE ratio, and then return on common stockholders' equity or return on equity. And we're going to look at some examples here. All right. So first, let's start by looking at earnings per share. In this case, they are presenting some comparative results for Kohl's Corporation for 2015 and 2016. And here we see how we are able to compute their earnings per share. In this case, we're able to take the net income less preferred dividends. In this case, there are no preferred dividends, and that's not unusual, okay? And then we divide by the average number of common shares outstanding. And in this case, we took a simple average. We looked at the average or the amount outstanding from 1 year, the amount outstanding for the next year, added them together and divided by 2. That's normally what we'll call a simple average. And based on that simple average, we arrive at an earnings per share of $3.48. Now, I can tell you in real world accounting, we wouldn't necessarily use that simple average. We would use what's called a weighted average, which is a bit more complicated. So that's the reason if you try to manually compute earnings per share, sometimes you have a little bit of a difficult time backing into it. Because those weighted average calculations can be pretty complex. Okay. Now, the price earnings ratio, What this does is it compares the market price of the company's stock against their earnings per share. Now, in this case, we see the calculation here for Kohl's, and we see that it's 10.63. Now, this is kind of a common point of, I guess you could say, controversy in terms of what exactly does this mean, okay? Is it better to have a high PE ratio or a low PE ratio? So essentially, in theory, you would think that it's always better to have a low ratio, okay? Because it means that I guess the market price is fairly reasonable based on the reported earnings per share. However, what we have to remember is we always operate assuming that our capital markets are efficient, okay? And what that means is, assuming that capital markets are efficient is assuming that market prices are always reflective of the correct value of a company's stock based on not only the company, but what's known about the industry, what's known about the economy, what's known about political stability, and everything else that could possibly factor in. So here's where I'm going with that. What a high PE ratio tends to indicate is the market feels confident about that company's future. Because what it when you see a high PE ratio, it sometimes kind of initially looks like, wow, their market price must be really inflated. But if we're assuming that the capital market is efficient, then that market price must be high for a reason. Investors must have some expectation that that company has a lot of future potential. They believe that there is growth opportunity in the future or something like that. So again, I'm not saying that low is good or bad or high is good or bad. I'm just saying that this is one of those ratios that you really have to think about it. And you really have to dig a little bit deeper to understand the meaning and to understand what's going on. Okay. Return on equity, that's a fairly simple concept. In this case, we're going to take net income divided by those preferred dividends and simply divide by the average common stockholders' equity. And again, we're just going to use a simple average. And in this case, we get a return on equity of 12%. Now, in terms of whether a given return is good or bad, it's one of those things where everything is relative. So what I would generally always tell students to do is, before you're trying to make an assessment of whether it's return on assets, return on equity, whatever the case may be, if you're trying to determine whether it's good or favorable, look at what the industry average is. In most cases, if a company is reporting returns that are higher than industry average, it's a good thing. If it's lower than their industry average, then maybe it's not such a good thing. So that's something that you have to always take into consideration.